Good evening, everybody. And I apologize for two things. One, for a late start, and two, because I'm losing my voice tonight. It's okay because I think people in Congress are losing their minds, so it puts me a step ahead of everybody on Capitol Hill. So you can see tonight, I'm wearing my New York Mets shirt, not only because of the start of spring training, but if you notice the year 1962 brings back the words of the immortal Casey Stengel, who asked, "Can anybody here play this game?" And, we're asking that about members of Congress, about people in the capital markets, and people in the media. It's insane, as we wrote today in our Making Sense report, the lack of understanding and the bias. And we're in rant mode tonight, so, there's no denying that. But the lack of knowledge that pervades the financial industry, the financial media, when Ms. Yellen spoke yesterday before the Senate Finance Committee, we had the New York Times come out with an article and a headline saying, basically, that she was hinting that the Fed is on hold, and we had the Journal same time saying that Ms. Yellen is setting a path for higher rates. Well, they're both wrong. She did nothing of the sort. Not a thing. All she said was that the Fed was data dependent and they're going to decide meeting to meeting. So right away, people read what they want to read into things. And this is what causes volatility. This is for a professional portfolio manager and a bond market professional. It presents opportunities because it's incredible the lack of knowledge that pervades the industry. First of all, Ms. Yellen comes out and says that they're probably on hold as long as patience is expressed for at least two meetings, right? But then she says that the Fed is data dependent. All right, so what is the Fed going to look at? Well, if you turn on the TV or the radio or read various publications, you're going to hear, well, look at GDP growth. We printed 5% in Q2 of 14 and 4.6 in Q2 and Q3 of 14. The Fed's got to raise rates. All right, we said this before in our reports and on this show. Please, somebody tell us when the Fed changed policy based on growth prospects. The Fed has never done that. Has it raised rates when growth was picking up? Yes, but only because inflation was picking up. So Bond Squad is putting out a challenge to everyone here. Please find a time in history when inflation and growth disconnected, they diverged, that long-term interest rates followed growth and not inflation. As far as we can tell, it's 100% of the time that long-term interest rates followed inflation. And inflation is going nowhere right now. Yeah, all right, maybe creeps up at the margins eventually, but tomorrow's CPI is supposed to print in a negative range for headline CPI, and core CPI is expected to print, and I get the latest update here on the trusty Bloomberg. Core CPI is still expected to print at 1.6%. That might be a little wishful thinking, but 1.6% on core is not 2% where the Fed wants it to be. Now, we have wage growth that ticked up to 2.2%. Great. That's still below any time in the post-war era on average. Since 1990, up until the financial crisis, average wage growth was over 3%. Now we're doing cartwheels when we get to 2%. The Journal has an article on their website tonight stating that there's good news because people are spending at Target, and they're spending at Dollar General too, by the way, and at TJX, and that they might have to hire more workers and there'll be wage growth. Great. We're going to have wage growth at the bottom. We're going to have minimum wages go up. So there's going to be a competition for retailing staff, and those jobs are going to turn into $50,000 a year white collar jobs that you can buy a McMansion with. Not that the younger generation is doing that. They're saddled with too much student debt, starting families later in life, having one or two kids. they're not going to need a minivan, never mind a house in the burbs. Will they buy a home? Yeah, they'll buy a condo or co-op in a renovated industrial building, in Williamsburg, Brooklyn. More power to them. It's probably a good piece of real estate, but that's what they want. So there's a mismatch in the housing stock and demand. But that's another discussion for another day. So let's go back to Ms. Yellen for a second. We take her at face value, and Ms. Yellen today says that the Fed expects the inflation to move up to its 2% comfort zone over the next 2 to 3 years, not 2 to 3 months, not 2 to 3 quarters, 2 to 3 years. So that means we could be below 2% for the next few years. All right, where's the 10-year Treasury note going to be when inflation's running below 2? We're pretty confident it's going to stay below 3. All right. Meanwhile, she did not say that the Fed will not raise the Fed funds rate until its inflation's at 2. She did say that the Fed would remain accommodative even after liftoff. But what's accommodative? Well, in the old days, accommodative could have been a Fed funds rate below 4. Below 3 was considered pretty accommodative. You got the 2, you were very accommodative. So we're talking that maybe by 2018, the Fed funds rate is topping 2%. If the Fed's behind the curve, maybe in 17, that's still 2 years away, they were topping 2. Not many credible bond market people. I'm not counting the rockstar fund managers that go on CNBC as guests, most of them talking their books and equity oriented. We're not talking 3%, 4%. We're talking about maybe getting to 2 on the Fed funds rate. So now you're back to this new normal. Mohamed El-Erian, Paul McCulley, who just resigned from PIMCO last week, back to their new normal, where you might get a flat curve again, like we said before, in and around 3%. Doesn't mean the 10-year can't top 3 and come back, but we're not seeing these rates blow out. But this has an effect on the economy. Why? See the great earnings that some companies are putting in. See how consumers can spend. All right, if you move rates, let's say the 10-year yield from it's just under 2. Let's call it 2, and you move it to 3. Well, that's a 50% move in an interest rate. Don't think of it as a point. Think of it as a 50% move. This is like when the 10-year note was at 6, bringing it to 9. All right. It's the same thing, and it impacts lending, it impacts spending, it impacts corporate finance, and that's when you start to see the cracks in the foundation. So the Fed's gonna be really careful with that. So we don't know, and no one does, how fast the Fed is going to act. We think it's pretty slowly, and with a lot of caution. We don't know how fast it's going to have to react. We're in uncharted territory, right? But we could be in a situation where rates rise what one might consider modestly or moderately, yet that's enough to cause corporate default to kick up, to impact corporate finance, to impact capital expenditures. So, we're in a brave new world here, and it seems like people don't get it. They just don't get it. They're doing cartwheels over 2% wage growth. They're jumping up and down that retail and restaurant workers might make $10 an hour instead of $8. All right, here's a little stat for you, and I have it up on my Bloomberg screen. I can't flip it around and show the audience, but according to the U.S. Census Bureau, in 2011 dollars, the average household real income, median real income right now was $51,939 a year. The last time it was that low before, recent times, because it ticked up a little bit over the last 2-3 years, was 1996. It looks like 1990. Yep, end of 96. In real terms, people are making less than any other time since 1996. Okay, before the tech bubble. This is not this is not the housing bubble or the tech bubble where people are seeing the incomes double. And we're not seeing people who are making $50,000 in a mid-level job because of the tech bubble, the housing bubble, get a job that's paying 6 figures. They're talking about people who are making 20 grand a year, maybe get 22. All right. So, hang on to your hats, guys. This is not going to be this blowout, this blowout economy. By the same token, look at Japan and Europe. They're going nowhere fast. The other day, talking back to Casey Stengel again, we described Japan as the '93 Mets, the worst team that money could buy. Remember the big payroll, Bobby Bonilla and company, going to rock the world. They finished last. We described Europe as the '62 Mets. Can anybody here play this game? They don't seem to understand what's going to drive this economy forward. They feel they can negotiate and legislate and sweep things under the rug and devalue their way to success. Maybe you'll stay out of a recession or depression, but you're not going to really, blow anybody's doors off out there, guys. So, that's where we're staying here. Now, you would think when Ms. Yellen's speaking in front of Congress that congressional leaders would have something constructive to ask her, right? And in the past, it was the Democratic side of the aisle that looked a little buffoonish, especially Maxine Waters, who actually, in her defense, actually was coherent this time. So, and she spoke with some, as if she learned something. So kudos to her. But then we have the Republicans like Bill Huizenga from Michigan. His biggest concern is that Ms. Yellen's spending too much time with Democratic leaders, and that she might be cozying up to them. All right, invite her to lunch then. Then he wants transcripts of their lunch and breakfast meetings and one-on-ones. Come on, please. Invite her to lunch. Ask her constructive questions. This is the best that our Congress people have to offer. How about asking how we, Congress, can help stimulate the economy? How about asking her, the effects of fuel prices on not just the economy, but the oil patch, which has been a big creator of wealth and jobs over the past 5 years? How about stuff like that? No, because we don't have intelligent people who are independent thinkers in Congress. We pretty much have, used car salesmen with law degrees. We'll sell you a bag of goods, a bill of goods, and we know all the legalese to wrap around it to make it constitutional. So great, thanks for doing nothing for us. So that's what's coming out of these meetings. It's terrible. Now, there was some question. I will go back to the articles in the Times and the Journal about what Ms. Yellen was saying. Now, the way the market's interpreted, the equity market interpreted, she's not doing anything to shake up the apple cart here, and that it was full speed ahead for growth, and the Fed's going to back it. The bond market thought something a little different. The bond market knows that the Fed's dual mandates are full employment and price stability, and full employment means that that everyone in theory who wants a full-time job, who wants work, can get work. And that's usually with the unemployment rate in the 5s. And by that time, you usually see wage growth, right? And if you're not seeing wage growth, that usually means there's labor slack. Well, you have a 5.8% unemployment rate. You have an underemployment rate over 11, right? There's labor slack, all right? And Ms. Yellen admitted that in the past, businesses, when they needed to increase production, would pay for labor. Now they're paying for capital expenditures, equipment, when they need to. All right, and equipment's not a canning machine or a bottling machine anymore. It's a computer bank, or it's a small computers on the cloud, or it's a mobile device, a tablet. One guy with a tablet running facilities, in 6 parts of the country. That's what they're spending on. All right, so it's changed. It doesn't mean that the economy is going to go into a recession. It could keep growing at 2.5%, 3%. The Bloomberg survey shows that economists think we'll grow at 3.10 this year, 2.8 next year, and 2.7 in 17, which is kind of concerning when you think that this might be the peak growth for this economic cycle. But that remains to be seen. We could write a book just writing down each time economic forecasts are wrong, and we can put ourselves in that book too. But we're not going anywhere as far as interest rates go, because the Fed has those two dual mandates. All right, one of them you could argue maybe or maybe not, it's been fulfilled with unemployment in the fives. We'd argue that it's not, and Ms. Yellen said as much, that there seems to be too much labor slack. But the other one is inflation, right, or deflation or disinflation. Remember, the Fed's mandate is price stability, not low prices. And agree or disagree, the Fed and most central banks have determined that 2% inflation is sustainable, it will generate sustainable economic growth. It's enough to bring asset values up. Remember, you want asset value appreciation, including home value. So you want to be able to borrow in today's dollars and pay in tomorrow's devalued dollars. It's kind of a Ponzi scheme when you think about it, but that's how it's supposed to work, right? So we're not even close to that, right? And the Fed wants to see that on core. It doesn't want to see it on headline, because the headline with food and energy, as you've seen, can get very volatile for reasons other than purely demand and economic health reasons, oversupply, weather, geopolitical events. They want to see what core inflation is. We're probably a long way off before the Fed has to become unaccommodative, for lack of a better word. Doesn't mean that they have to keep rates near zero. We think by this time next year, maybe the Fed is at 50 basis points on the Fed funds rate. By this time in 2017, maybe the Fed is up to 1.5 on the Fed funds rate. It's moving it higher. That's still accommodated, even in the new normal. That's pretty accommodated. 2-ish is getting close to neutral. 2.5, maybe 3-ish. That's just like getting to neutral to somewhat restrictive rates. We think in this environment. So, but the market, that's how the bond market interpreted it. The bond market, if you look at a chart, we featured in today's report, shows that when she started talking about inflation or lack thereof, remember, she made the comment yesterday that although the Fed believes inflation is going to trend towards their 2% goal, it could go lower before it goes higher. All right. When the bond market heard that, yields, interest rates on the long and short end of the curve, albeit for some slightly different reasons, trended lower. The long end of the curve prices in inflation expectations. Right? Why? Because if your money's going to lose purchasing power over time, you want a higher rate of interest to compensate for that. But if your money's not going to lose that much purchasing power over time, you don't need that much extra yield to compensate yourself for it. So those yields went down, and we had the 10-year sitting right now about at 196, 187 as we speak, as it trades overseas. Meanwhile, on the short end of the curve, we saw rates go down, and we saw a strong 2-year auction yesterday, and we saw a really strong 5-year auction today. Why? Because they don't think the Fed is moving rates a whole lot in the near future. So it's safe to buy a 2-year. You're not going to buy a 2-year now and have a 2-year 20 basis points higher, over the summer, and then 2-year another 20, 30 basis points higher than this time next year. They think that rates are going to be fairly low there. So investors, including foreign central banks, were encouraged to go buy the short end of the curve. So the bond market is clearly focused on inflation at this point. The stock market's focused on Tina. There's no alternative. We got to go. Yeah, earnings look good. The Fed's not going to upset the stock market. Let's go in. It's fine if you're a trader or you're playing momentum, or if you're a long-term investor. If you're 25 years old and you're buying, a long-term, large cap growth and value stocks, buy it, because 30 years from now, when you need to start moving that to fixed income and preserving the capital and taking the income on it, there's a pretty good chance, and probably better than pretty good chance, that your stocks will be worth more than they are now, right? So you don't care. You're not a trader. Don't listen to the TV commercials that you could trade. You get all these systems. You're not a trader. I'm a trader. I have a lot of experience. You're not a trader, all right, for the most part. Maybe some of you are, but for the most part, you're not. You're an investor, or you're advising investors. Stick to what you know. All right, so that's how we see bonds moving. So this whole idea that you're going to be in trouble, the rates are going to go high, no. Watch out though for your tips and your corporate inflation adjusted note paper. Why? If we start to see year-over-year deflation, those tips in the indexes that adjust your principal, could start to fall, go negative. We saw it big time during the financial crisis when we had real deflation. You can see modest downturns there. Now, at maturity, a tip pays $1,000 per bond minimum, no matter what. Be careful though if you're buying stuff with indexes above 1, because they can if we have deflation, you're going to get at least 1 on the index, but that's still lower than what you got. You can lose money on a tip if you buy it with the index above 1. Be careful with that. But on the corporate IPI notes, those are the ones where the coupons float off of LIBOR, and there's a 3-month look back, or they float, not LIBOR, I'm sorry, off of CPI with a 3-month look back. You're going to get the year-over-year negative. Well, that's going to start minusing, taking away from the coupon. So for instance, if you have a bond that trades 200 basis points over the year-over-year change of the rate of inflation, just to make it simple, right? Simple as I can. And that year-over-year change is negative 0.5. So you have deflation, not dramatic, we have deflation. Well, instead of adding 200 basis points to a positive number, you add 200 basis points to a negative number. In essence, you subtract that 50 basis points from that spread of 200, and your coupon goes to 1.5. Some people think that the initial coupon is the base coupon. Some people think that spread of 200 or whatever basis points is your minimum. Your minimum is 0. And we saw some of these corporate IPI coupons hit 0 back in 2008. Now, I don't think it gets that bad this time. I don't think deflation is catastrophic like it was back then. We don't have a systemic failure of the economy and near failure of the banking system. But, those are probably going to underperform. We're using tips only in rare spots as hedges for some inflation protection. But if you're laddering or barbelling a portfolio, it's its own protection. Which brings us to a subject that came up today from one of our subscribers. One of our subscribers emailed us and said that both wholesalers and even someone with a PhD in economics was suggesting that if you have bonds at a premium, take the profit and buy and move on. All right. If you're in bonds for total return, it's a trade, and you got a nice fat premium, and you're going to go spend the money or invest it into another total return type investment, there could be a case where you want to take that profit and go. But if it's an income-oriented account, you don't want to do that. Why? Well, what's the difference at maturity if I have a 5% bond trading at 115 that matures in 10 years, or I have a 3% bond at par that matures in 10 years? Well, if I'm buying them both at 3%, let's say it's an efficient market, and all 10-year A-rated corporate bonds are trading at 3%. Now, it's never that precise, but to make it simple, we assume that, right? That means that the 5% bonds also trading at 3%. So let's say it's at a 115 handle. But the thing is, you're getting almost double the income on the 5% than the 3%, right? So the extra income is offsetting your amortization from 115 to par. And if you do the math, and we did it, and it's going to be in this weekend's In the Trenches, at maturity, you get basically the same amount of money, even with that amortization to par. Whoever is out there saying, oh, you can't hold a premium because you'll lose money, becomes par at maturity, all right, we're going to be blunt, is an idiot. They're an idiot who does not know what they're talking about. All right, but these people are popular. Probably the same people told people about Iceland bonds, 6 months before they defaulted. But that's another story too. So bonds are not the best total return vehicles. Yes, you can use fixed income in a portfolio for inverse correlations to equities, but when you're getting close to retirement, you need that preservation of capital, and you need that income, and only a bond's really going to do it. There are target date instruments out there that are probably the next best thing, but they track indexes, and sometimes the bonds that are rich. If you don't have enough money to do a bond portfolio, at least $100,000, bare minimum for fixed income, then do a target date fund or something like that. Just remember, you don't necessarily get par at that final date. You probably get something close, but either way, but you're not guaranteed par. Get all your money back. But that's probably the next best thing. But if you're looking for capital preservation and interest income, a portfolio of bonds, laddered, barbelled, matched to some future liabilities you might have, you might expect down the road, that's the best way to go. We do that for people. We just put an emphasis on Bond Squad income solutions. What we do is not try to build you a trading strategy, a total return strategy, but the population is aging. More boomers retire every day, and they live longer. This could be a 20 or 30-year trend of a strong need, not want or desire, strong need for capital preservation and interest income, which is going to keep the demand for bonds very high, by the way, and keep real rates fairly low. But we're building those portfolios. All right, you own the portfolio. You're not subject to the sale or buy actions of others. There's no rebalancing at the end of the day. They're yours. Yeah, is it a lot of work for us to do that? Yeah, but we charge a fee, so we expect to do some work for it. It takes more than gathering an asset to justify a fee, in our opinion. So we're building those portfolios. The demand out there is just going to get higher for them. If you're trying to do it in bond alternatives, you're probably going to end up blowing yourself up over time, especially when and if rates pop. We don't think they are, but it's always possible they do. So that's our niche at this point. We are going to be the income generator for people who until now maybe have been mutual fund clients and or ETF investors, and when you need interest income and capital preservation, they just don't do it. We're going to turn our rant mode off now. It's after 8:30 Eastern time. We have CPI tomorrow. We do not expect CPI to surprise to the upside. 1.6 the street consensus. Could have come 1.7, yeah. Could have come 1.5, yeah. We have a sneaky suspicion comes at 1.4 or 1.5 based on what we've seen out there. And that's core, by the way. Headline CPI, when you count in the drop in oil prices, that's expected to run at an annualized, not a monthly, an annualized negative 0.1%, down from 0.8%. That's good inflation deflation rather, for the most part. But don't underestimate the negative impacts to the economy from the oil regions. Remember, Texas, 7% of the population, 8% of the population, 28% of the jobs created since 2009. Just keep that in mind when you're cheering oil prices that are too low. We probably would be better off with oil 60 or 70. Everybody wins. Consumers get a big break from 100. The pumps keep pumping in the oil patch. But so it's. Too much of a good thing is a bad thing sometimes. And with that, we'll wish everybody a good night. Please call us if you have any questions, or email us. Our number during market hours is 570-424-1555. You can reach me anytime in email. I don't know how quick I'll get back to you after market hours, but I'm always checking the email. It's thomas.byrne, B-Y-R-N-E, at the @ sign, WS, that's Whiskey Sam, the word and, A-N-D, the letter M.com. And with that, have a great night. Stay warm. Spring is almost here. March starts on Monday. And we're closing in on about 40 days till baseball opening day. Spring is almost here, guys. Have a good one.